Hey trader, be sure to watch this video all the way through because I have a very important message for you at the end.
Hello there. Today's Saturday, July 27th, and in today's video I'm going to show you one of my favorite, most reliable trading strategies, or trading tricks, I like to call them, that I've ever found. I'm always on the lookout for cool trading tricks, and especially guaranteed. I want to use that word carefully because there's nothing guaranteed in the market. Even if there was, I think I'd be forced by the powers that be to say that there wasn't. Like if I found the Holy Grail, which this isn't the Holy Grail, but let's say I found the Holy Grail and I wanted to tell everyone about it. The powers that be would require that I say that there's no such thing as the Holy Grail. Anyway, forget about that. I just got off on a crazy tangent there. So back to this. This is a strategy, and it's not even really a strategy, just common sense, really. But there's a trading vehicle. There's a trading vehicle out there that allows you to take advantage of this. And there was another one at one time, but it blew up. So that's something to keep in mind. The first one blew up, so that wasn't good. But the second one, this new one, they have some hedges or some stops in place to keep that from happening. But it also is really important to not bet the whole farm on something like this, especially when you're getting started and you don't know anything about it. I can tell you what I've done in my experience, the trades that I've done. Actually, I've never lost on this trade. This is like, I used to call it the closest thing to a sure thing, to a guaranteed profit that I've ever found. And there could be some crazy things with this one too that, it causes problems. So I would never ever put my full money into this. I have a little part of my portfolio, my trading portfolio, that's I just kind of set reserved for fun, for more experimental type trades. I would put this into that bucket, probably maybe a little bit more, and the more I trade it, the more comfortable I am with doing it. Every single time I've done it, it's worked out, and when I show it to you in a minute, you'll see why. It's nothing fancy, it's nothing crazy genius, it's just like common sense. So anyway, this used to be my closest thing to the sure thing that I had until just a couple months ago. I found the OG trade, which totally beat this one. And if you haven't seen that strategy, just make sure you're subscribed to this channel because I'm going to be doing a bunch of new videos on that coming up. But anyway, back to this one. This is a trade that I'm calling the Sir Isaac Newton trade, in honor of the famous historical figure who created fig Newtons, Sir Isaac Newton. God, I love those fig Newtons. I haven't had those fig Newtons since I was a kid, and about a year ago I saw them in the store and it brought back all the memories. I was like, holy moly, remember these things? And I bought them, and I ate the whole thing before I got back to the house. I love those. Anyway, this trade I'm calling the Sir Isaac Newton trade, based on that historical figure who, I guess, what do they say? Did he discover gravity? Or he's like the super genius who got hit in the head with the apple and realized the whole thing about gravity. And I also have another alternative name for it, and it's called What Goes Up Must Come Down. Remember that song? What's that song, that famous song back from our time, back from our day? What goes up must come down. So this is the Sir Isaac Newton / What Goes Up Must Come Down trade, and it's based on the idea of similar to gravity. What goes up must come down. So if you were to try to imagine what type of a guaranteed thing, a surefire thing that you're absolutely 100% positive would happen. There's always a chance that it won't, but it's so remote that you're willing to bet money on it, at least a small portion of your capital. And again, none of this I'm about to say is trading advice. I'm not a licensed anything. I'm a licensed imbecile. I'm just some dude on the internet. But I do have a lot of trading experience, and I've traded this particular strategy I'm going to show you today. Anyway, that's my disclaimer. None of this is trading advice. I'm not someone that should be giving you trading advice. You need to do your due diligence. You need to talk to somebody. You need to do your own research on this. I'll provide a bunch of research and links in my trading school site where you can get in there for free, plus additional videos that talk about this. To do that, just go to, I'll leave a link in the description below, the Trading School with a K, Trading School website. I'll devote a whole section to this trade where it'll be full of actual resources, stats, everything you can imagine to really do a deep dive into research, which you should do. And absolutely don't trade with real money until you paper trade this and you do all your research, you talk to everybody. Like my friend Rob says, you can trust, but always verify. Look both ways before crossing the street. Most importantly, don't eat yellow snow. All right, so back to this now. Let's get going. So what are some things that you are so sure of happening that you'd be willing to bet some money on it? And I'm talking about things that are like 99.9999999% sure that'll happen. There's always the possibility that it won't, something crazy, weird happen. But these are like, this isn't just like, just sort of like guesses or gambles. These are things that just kind of ingrained in our heads that this is what will happen. So let's say, for example, the sun will come up tomorrow morning. So I'm pretty sure that's going to happen. And in fact, I'm so sure I'm willing to bet some of my hard-earned money that yes, the sun will come up tomorrow. If someone were to say, you want to bet the sun won't come up tomorrow, I feel really super comfortable saying, sure, I'll make that bet. The sun will come up tomorrow. Now, the sun may not come up, but the sun has always come up. The sun is based on the mechanics of the universe and all that blah, blah, blah stuff. I'm willing to bet with a strong conviction that the sun will come up tomorrow. So what's another one? Let's see. Here's one. If you jump out of an airplane from 30,000 feet in the sky without a parachute, when you hit the ground, you'll die. Is that a bet I'd be willing to take? Sure, I'd take that bet. I'm really super confident and sure that's going to happen. All right, let's do one more. Let's say that if you go outside your house, take a brick, throw it up into the sky. I would say that it's 100% guaranteed, or 99.99999% guaranteed, that that brick will fall back down from the sky. If you throw it up in the sky, it's not just going to sit there and float. It's not just going to keep going up into space. It's not going to fly away like some bird. Because of gravity, that brick is going to fall back down to the ground from the sky. So in the market, what kind of a thing or situation is similar to that? It's something that you'd have that much confidence, as much confidence as the sun will come up tomorrow, of something happening in the stock market, some sort of an event or a situation where you know what the outcome is going to be, where you are completely 100% or 99.999% sure of what the outcome is going to be, as much as you have the confidence that the sun will come up tomorrow. What type of a situation in the stock market can you be that sure of? Well, the one that this strategy, this what goes up must come down strategy, deals with, at least in my book, it's that same type of a situation. I'm 100% sure, 99.99% sure that I know what will happen, and I can make a trade on it and I can profit on it. So what is that? And there may be other ones out there too, but this one is just so, especially as an options trader and trading options for the last 20 years, this one is just so ingrained. I mean, it's just so obvious and so ingrained in my head, having traded options for all these years, that I am as sure that I know what the outcome will be from this type of an event as much as I have the confidence that the sun will come up tomorrow. And what is that? It's the what goes up must come down trade, which is a super simple trade that's based on the fact that if the VIX, the VIX goes up, spikes up, especially spikes up really high above a certain level, that in time, sometimes immediately, sometimes over a few days, sometimes over a couple weeks, it will come back down. It's like the whole gravity thing within the stock market. The VIX is the only thing I can think of that I can have certainty of that happening with, or something similar to that over anything. I mean, no one knows for certainty what a stock will do. No one knows for certainty what the outcome of a Fed event will be, an earnings event. I mean, I can't think of anything else in the stock market that has as much certainty as the fact that if there's a spike in the VIX above a certain level or a certain range, or especially like an extreme spike, I am 100% certain, well, let's say 99.9999% certain that the VIX at some point will come back down from that spike. And if you don't know anything about the VIX, I don't really want to get into talking about the VIX and all the details of this thing today. I want to keep this nice, short, and sweet. But if there's enough interest here, just put it in the comments below, and I can build out a whole training on the VIX and how the VIX works, and numerous strategies based around this what goes up must come down strategy. This one I just want to put out there because this is like one of my number one favorite trades that has always paid off for me. And so I just want to quickly lay this out. And then if there's any interest to dig deeper into this thing, just let me know. Just email me or just leave it in the comments below, and we can really do a deep dive into this. Not only this strategy, but other strategies just like this. It's trading volatility, basically. It's trading stock market volatility, which is like this whole other thing, this whole other dimension where you can extract profits from the market from. But it's a little bit more, I want to say complicated. It's just a little more, just a little bit more advanced, and it takes a little bit more to grasp and to really get. It's just, it's looking at things in an entirely different way. So anyway, if you're interested in digging in deeper in that, just let me know either in the comments below or through an email, and we can dig into this thing as deep as we want to go. But today I just want to keep it real quick, short and simple, and give you the basic idea here and show you my favorite, most simple, most obvious, most consistently profitable. Like I said, it's the closest thing I can get to a sure thing other than my OG trade. But real quick, let's just take a real quick look at the chart of the VIX. Okay, so here's the chart of the VIX, and Again, I don't want to get into the deep weeds here and get into the nitty-gritty details of the VIX, how it works and all that. I'm just going to give a brief overview today on the VIX, and you probably already know what the VIX is, but just in case for those who may not, I'll just do a quick, really super fast pass through this thing. So anyway, here's the chart of the VIX, the VIX. So the VIX is the simplest way for me to describe the VIX is it's like kind of like a barometer. It's a gauge of the fear in the market. And when the stock market is going well and climbing and everything looks rosy and fine, the VIX is low. There's not that much fear. It's like the fear index. The fear index is at a very low level. So you can just see through these low levels here. And it's always, ever since I started trading this back in the 2000s, it's been like around 9, 10, up to like 20. It's just kind of like the range that it was mostly at. During the pandemic, you can see during the pandemic, well, this isn't even the pandemic. What is this? This is, I don't know what that is. Let's see. Let me go back to let's look at like a weekly. Let's do how do I put in my own time frame? Let's say daily. Let's do 5 years day. Okay, here we go. So you can see the pandemic here. All time. I'm not sure. It's probably all time high. But it's as high as you'll see it on this chart. So you can see that before the pandemic hit that year, we were just down in the normal range. And I consider the normal range between, well, I would say between 10 to 17-ish, 18-ish, maybe 20 in that range. That's just kind of like the normal range where it's usually at, where there's not a lot of fear and things are looking pretty nice and comfortable and rosy in the stock market. Whenever there's some type of a news event or something that happens or something that would cause fear in the market or cause people to want to get out of their stocks or to get insurance on their stocks, like buy puts, the VIX will spike. It'll spike up. So you can see here, way back here, this is right before the pandemic came out, the news. This is 2020, probably January-ish. And we're in our normal range, our normal level. When the pandemic hit, you can just see how this thing has taken off. I don't think I've ever seen personally the VIX get as high as it did during the pandemic. This was crazy high. But you can see because there's fear in the market now, and remember the big sell-off we had. Whenever the market sells off hard, whenever there's a news event that causes a sell-off, the VIX will spike. It'll spike up, just like it did here during the pandemic. So it went all the way up here to 85.47. And again, the normal range is between 10 and 20-ish, in that range there. But the world didn't end. And just knowing how the VIX work, things will, over time, sometimes sooner, sometimes later, will get back to normal, including the market environment. And the fear will subside, and everything will go on with our lives, and things get back to normal. And that's the VIX coming back to its normal, going back to its normal range. We're not afraid we're all going to die. We go back to our jobs, we go back to our lives, and the VIX settles back down and comes back to reflect that. You can see, because this was such a big spike, it took quite a while for it to get back. You can see it up in here. We were up in the 20-30 range, and that was more of an elevated range in the VIX that I've seen for that period of time. But it's just kind of the residual effects of this huge spike up to 85, I think. You can see over the last couple years here, it's come back down. It's way back down. Right now it's at, where is it at today? Today it's at 1639. Here it was at 10. That may be a misprint. I don't know. But I've seen it like at 10 before. Let's go back just a little bit further. Let's go back to, let's say 10 years. No, you know what? Let's go back 20 years. Oh, it won't even show us 20 years. Oh, yeah. Okay, so I guess that's, well, maybe I can make this window bigger. Let's see. Okay, so here's 20 years. So you can see the pandemic made it spike up to outrageous levels, and then it comes back down. But you can see it trending down, getting more. Things are getting back to normal. Things are getting back to normal. Things are getting back to normal. Oh, something happened here. I don't know what happened here. Something, a little spike. Sometimes these are like a weird news event or some type of a sell-off. Maybe even a correction can do that. A sell-off, war. I think when the Ukraine war started, the VIX probably spiked. When there was that scare just a couple months ago when Israel invaded something, I don't know, Iran or whatever that was, the VIX spiked. So the VIX will spike up. And the bigger the deal, like the pandemic, the higher it'll go. But unless it's the end of the world, as long as things come back to normal, the VIX will come back down to its normal range eventually. Or let's say at least a lower range. It couldn't have maintained this high here. This was at the peak of the fear of the pandemic when we thought we're all going to die. But it can't maintain that type of a level, super high elevated level, unless, what is that saying? The whole shit house goes up in flames. The whole hen house goes up in flames, or the crap hits the eternal fan. But what I'm saying is that it can't maintain that level unless it's the end of the world, and then we don't know anything. We don't know any better because we're all gone. But it could keep that level for a while. But that type of a fear in the market can't really be sustained. At some point, just like gravity, if you throw an apple or a brick, like the brick I try to use to kill my brother. If you throw a brick up in the air, the laws of gravity say that that brick will come back down. And it's exactly how I look at this VIX trade. So if the VIX spikes up, it's going to come back down. The higher it spikes up, the more it'll come back down. And over time, it'll always, it's like a reversion to the mean. It's going to come back to its average level, which again, I've found to be like in the 10 to 20 range. Let's go back in time here real quick. So we'll kind of scroll back through here. So before the pandemic, you can see the VIX was in this 10 to 20 level. There's a spike here. I mean, it'd be cool to see, to like put markers on this, like just write in events, like what caused this. Something happened in the world or the stock market to cause this spike up. But again, just like throwing a brick up in the air, it's going to come back down. Unless it's the end of the world, and then we won't know any better anyways. So something happened there. What is that? That's like 2618. I don't remember. That may be some like volatility Vomageddon or something. Vomageddon, the zombie, the VIX zombie apocalypse. But so it spiked up, and relatively quickly it came back down. It didn't come back down to where it was immediately, but it did come back down, and eventually it did get back down in that range again. So then again here, something happened here, and I don't know what these dates are. It would be really cool for me to, maybe if I get some time today, I can put together like a sheet, like a graphic that shows what these events are. Here's another one. This was like kind of a big event. Something happened here on 12/26. Maybe that's when the Grinch stole Christmas. Something bad happened there, or something happened to cause the VIX to spike. But once again, like throwing a brick up in the air, it came back down. Now, there's no other vehicle that I'm aware of that will do this. Like, I mean, there's no stock that will. The thing with this is that you can't predict when one of these terrible events will happen. Like, you can't predict that the Grinch is going to steal Christmas here. So that's just totally a gamble. You have no idea when an event is going to happen. But what this whole strategy is based on is that once an event does happen, or once the VIX does spike, which you can see happens repeatedly, sometimes bigger, sometimes smaller, but it does happen like quite regularly. Something will happen and the VIX will spike. And again, we can't predict what those events are that will cause it to spike. So that's not what the trade is based on. The trade is based on the fact that once the apple or once the brick gets so high up into the air, we're then betting that that brick will fall back down, which is a totally predictable thing and intelligent thing to make a trade on. Again, we can't predict that there is going to be a pandemic, a worldwide pandemic here. So there's no point in trying to say, well, I think that, I'm going to go see a soothsayer and they're going to tell me that this is going to happen. I'm going to try to get in here and make this money. So we're not making any money. The strategy is not based on profit at all from the actual event, from the move up. We have no idea when that's going to happen. But what we do know is that unless it's the end of the world, and depending on the height of each spike, I can be certain, I believe that it's guaranteed 99.999% of the time that once that brick is tossed up into the air, at some point it will come back down. So we're making money on that move down. There's a way to take advantage of this trade. There's a way to make money on the move down, for all these. Let's just go back real quick here and see some more. Look at this one. This is a pretty good one. This is up to 50. This is on 8/20/15. And again, I traded through all these, but I can't remember. I can't really remember which each one is. But you can see again, this is down here in the range between 10 and 20-ish. Usually that's sort of like what I consider to be the normal range for the VIX. But you'll get these spikes, or even if we're on the lower end of that range, and we get a spike up, like a little spike here, there will be some pullback there. little spike here, there will be some pullback. This is a bigger spike. There's going to be pullback, more of a pullback. Spike there. There's going to be some pullback. We're way down here now at 10. Look how low the VIX is there. 10. Down here, it's really low. But all these little spikes, they come back down. It's like the brick is thrown into the air. It's got to come back down. The brick is thrown into the air. It's got to come back down. The brick is thrown into the air. We get in. It's got to come back down. The brick is thrown into the air, way up into the air. Somebody with like a super strong arm through that one, like a Hulk Hogan toss. It's going to come back down. And there's spikes and little spikes and movements on the way back down. Up in the air, it's going to come back down. It's up in the air, it's going to come back down. This is like, to me, the way this works is as certain to happen as the sun will come back tomorrow. The sun's going to go down tonight, and it will rise tomorrow. That's how much certainty I have, how much confidence I have that this will happen. And so that's what this whole trade is based on. Just real quick, let me come back and look at some of these. So look at these moves up. What is this one? This is, that's the financial crisis of 2008. That was a pretty good one. Look at that. We're up there at 89. So that's kind of like pandemic level. That's interesting. I didn't realize that. But you can see this one stayed up a little bit longer, sometimes higher, sometimes lower. But there's spikes in here. But over time, so this is like in a period of, this is like September 2008 to around the first of that year. It stayed up there and was gyrating around, but it did come back down. It wasn't at the end of the world. The brick came back down. So that's what the strategy I'm about to show you is based on. That's what runs this machine. The law of stock market gravity. No, the law of VIX gravity. Let's call it that. The law of VIX gravity. What goes up must come down. The Newton Apple trade. And so how do we take advantage of that? So again, we're not trying to predict when some random event that's going to cause the fear index to spike up. I mean, that's futile. That's futile. But once that brick gets tossed up into the air, at that point, we now know, well, based on the law of VIX physics or VIX gravity, Newton's apple, what goes up must come down. We know that once that brick is thrown up into the air, it's going to come back down. Or we're 99.99999% certain this is going to come back down. And so that's where we make our money. We make our money on that law of gravity fact that it's going to come back down. So how do we do that? So there's a volatility product called the SVIX. And again, I don't want to get into the details of all these. These are like, this is like an inverse ETF, volatility index. I mean a volatility ETF. And there's a number of these. There's quite a few actually. And there was one that did the same thing, but it blew up. So it's important to understand that it's important for you to do your research, and I'll provide a bunch of links and videos and additional stuff that can give you as much research as you want to do on this. And you can dig in as deep as you want. So there was an ETF that did something similar to the SVIX a few years back, and then some random weird event, I think it was Volmageddon. I think it caused it to blow up. But then this new one, this SVIX, was I'm going to show you right now, the SVIX. It came out just a couple years ago, and supposedly or apparently, again, don't quote me on any of this, you need to do your own research, which I'll provide links where you can do that research in the description below. But apparently there's like the way that this is built, or some of the mechanisms in it, some hedging, I think they've recently added some kind of a hedging technique to it, will reduce the probability of that happening. So once again, even personally, I wouldn't put my whole portfolio in this, no way. This is going to be my little 5% of money that I have set over to the side as quote unquote risk money or fun money. I'm not going to bet the farm or my kids' lives. I don't want to stay in this type of a trade for longer periods of time. These are quick hits. These are when we see the spike, we see the brick thrown up into the air. We want to take advantage of that brick falling back down and then get out. That's how I'm doing these. So what the SVIX is, and again, I'm not going to get into the details on all this, but I'll leave plenty of links and research material in the description below, so you can dig into this as deep as you want to your heart's content. So the SVIX is an inverse ETF. So basically what that means is just an ETF based on the movement of the VIX, except it's the inverse of the VIX. So let me pull up another chart here. Let me go to two charts. And so on this side, we'll put SVIX. So here on the right side, we'll see the, let me make this bigger. So here on the right side, this is the SVIX. On this side, let's put the actual VIX, the VIX. So, and let's make sure that these dates are the same. So daily, let's turn this to daily. Okay, there we go. So if you look at this, you can see that this is the inverse. So this is the exact opposite. It's like the mirror image of the VIX. Again, this is the VIX over here on the left. This is the SVIX on the right. So let's just take it back recently. So I actually made a trade on this. I actually did a trade on this. I'll show you in just a second. So here's the VIX. So you can see that we're down here in this lower range. We've been going down lower and lower. Everything is cool in the market. The birds are singing, the sky is blue, cows are mooing off in the distance. It's a happy place, and it's a place with not much fear. So, which is why the VIX is down in this range of 12 to 14. But then, over the last couple of days, there was that big down move. If you've been following me, let's see. I could probably turn this into 3. Let's add one more of these. Okay, so here let's put in another one. Let's put in the SPY. So here's the SPY. This is the S&P 500 ETF. So you can see how all these are working in tandem together. So again, over here on the far left is the VIX. Over here in the middle is the SVIX, which is the inverse, the exact opposite of the VIX. And over here on the right is the SPY. So you can see we recently hit this high up here of 564-ish, or whatever that was, in the spider. And then over the last 2 weeks or so, we've had this correction, this down move. And the down move will usually cause the VIX to spike. So right here, we see the VIX spiked, went up. Fear entered the market. Like, what in the F is going on here? Why are we moving down? Why are we crashing? So the VIX spiked up as the S&P came down. But at the same time, the SVIX, the inverse of the VIX, came down. So this down move is the exact opposite, or the mirror image of this move up in the VIX. So the VIX went up, and as it went up, it was reflected in the SVIX by a move down. So again, our whole strategy is to not try and predict random events that's going to cause fear to enter the market. Surprise events. That's basically what these events are that causes the VIX to spike, or surprises. So there's no way to predict a surprise event, because then it wouldn't be a surprise event. So surprise events like this will continue to happen, and when that happens, the VIX will spike up out of its normal range, and when it spikes up, the SVIX, which is the exact opposite, it's the inverse of the VIX, will come down like it did here. The VIX spiked up, the SVIX came down. And what's cool about the SVIX is, so these are shares, but they also have options on it. I haven't even traded the options on it yet. I just use the shares. So when it comes down, you can just buy shares of the SVIX and then ride it back up. You're riding the SVIX back up, which is something that, at least in my opinion, it's like the sun coming up. The sun will come up tomorrow. The VIX will come down eventually. So the VIX has spiked up. The SVIX has spiked down. So I believe that the world is not going to end on whatever this event is, and it's going to return back to its normal average lower, or a lower level, which the SVIX, because it's the exact opposite, it's a reflection. It's like the inverse, the mirror image of the VIX. When this comes down, that means the VIX is going up. This is the move of the VIX, of the brick being thrown up into the air. And if I believe that brick is going to fall back down, as gravity says it will, then the VIX will come back down. The SVIX, which is the mirror image, the exact opposite, the inverse of the VIX, will go back up. So it gives us an opportunity to get in at low levels. So think of it like this. So if you had a favorite stock you wanted to buy, you wanted to get in at the best levels possible, and throughout the year, let's just say Disney. Let's say Disney's going up. We love Disney, and we want to get in at lower levels of Disney, but we want to get the bargain prices. So we don't want to buy Disney shares when they're high, or even when they're in the normal range. If we had the choice, we would ideally buy Disney at the lower levels, at their lows, their swing lows, and then ride them back up. So you can think of it like that with this. This is giving you the opportunity, with much more certainty, at least in my opinion, and much more of a guarantee that you will make money, that it will go up, than if you buy Disney at the lows. If you buy Disney at the lows, it could continue lower because it's just a stock. But the VIX, because of the law of gravity here, the VIX gravity at play, the brick gets thrown up in the air, it must fall back down. I know, or I have a higher degree of certainty, that there will be a move up of some type. And the higher the VIX goes, the lower this will go, giving us a better entry opportunity. You can see that right now we're trading at like $42 a share. But look at this one down here. We were down at 20-ish, 21. So when there's a volatility event, VIX spikes, the SVIX comes down, giving us a great, wonderful, low-priced opportunity to get into this SVIX and ride it up on its inevitable return back up as the VIX goes back down on the law of gravity. So this is like the law of gravity in reverse. What goes up must come down on the VIX. In SVIX world, it's what goes down must come up. So that's the basics of the strategy. And again, so I've done this numerous times, and I just did it last week as VIX spike. So what you can see here on the SPY, we hit this high, and then during this move down, the VIX of course goes up, and which caused the SVIX to go down, giving me an opportunity to get in. Now, over the last, since like October of last year, we haven't had a lot of opportunity to get into these. So this isn't like a trade that you can rely on every month to be profitable. You sort of have to wait for the spikes to happen. You have to wait for the bricks to be thrown up into the air. But when they are thrown up into the air, there's way more certainty, at least in my opinion, almost guarantee, disclaimer, that the brick will fall back down and you'll make money. So some of the ways I like to get into this, there's no way I would get in. So I did a trade this last week, and so I just start to scale in. So when there's a significant enough spike in the VIX, and let's just move the VIX over here for a second. I'll show you how I play these usually. So we're down here in the range of the VIX of around 12, right? These little spikes here, I don't even pay attention to. This is just kind of the VIX moving around. But here's a little spike, and if I would have been on the ball, I may have tried to grab that. A spike up out of its normal range here. I may just get a few shares of SVIX, and you're buying them, so you're not shorting anything. This is the inverse. The SVIX is the inverse, so you're buying shares for it to go up and the VIX comes down. But there's no way with a little spike like this, or even this one. This is a spike up. This would be an opportunity to maybe get in a couple shares, just kind of like test the water. Like, what do you call them? You call them scouts. My friend Rod calls them scouts. You get these scouts out in the market to kind of test it and see. And if there's a bigger move or a bigger follow through up, you have a couple shares at this entry level. And you can, if it continues up, you can continue to add shares. Just kind of slowly scale in. Now, on a big spike like this, I may get into more than just a couple. Maybe I get into 1, 2, or 3. Let's say 5 shares here, just something small just to get started. But then it came back down, and there was no follow through. But there was money to be made there on that spike on the SVIX. So this falling from the brick gets thrown up here. We get it in somewhere on this day, a couple shares. We're ready to buy more if the move continues tomorrow. But it didn't. It came back down. We cashed out those shares, those couple scout shares that we had, when it gets back into this kind of normal range. Here's another one. So this spiked up. Now, for me personally, I did not trade this one, but had I would have gotten probably into more scout shares on this one. It's a little bit higher up. We're in the 20 now, the 22 range. That's a pretty good spike up at the VIX. And I may be scaling all the way up in here. So let's say on this day it moves up. I may get, like, say 5 shares there. The next day it goes higher. Okay, so maybe there's follow through. I'll maybe add 5 shares. Now I have 10 shares. Here, there's a little bit of a move down. I don't do anything. I just kind of wait to see what happens the next day. The next day there's a big move up. I may get into more shares here. But remember, everything here is the inverse on this. So as we're going up, the brick's gonna fall back down, which is going to cause the SVIX to go up, and we'll make money on that move back down to the average normal range, where we get rid of everything and we're back to square one and we're ready to do it again. And this is one that I did do. So I just did this the other day. I'll look at the trade in just a second. I think once we got up to around the 17 level, I got in at 100 shares, with the thought being that if it's just like a one-day little blip, like a weird little spike, and it comes back down, I can make a quick little profit on that move back down and get rid of them when it comes back down to the average range. But it continued to move up. So it moved up this high. Now, I haven't added any shares at this point. I still only have the 100 shares, but this may be a position where I may want to add more. If it continues to move up next week, I may want to add more. I want to scale in. I want to keep some of my powder dry. So I don't want to just like put all the money I plan on investing in this on this first little 1, 2, or 3 spikes. I want to scale in, because worst case scenario is just going to come back down to the average range, and you will make some profit, and then you can just hit the reset button and start again. But if it goes up, you can scale in here, get 100 shares. If it keeps going up, I may get another 100 shares here. If it keeps going up, I could add 100 shares. And if it continues to move up like it did here, I'll have these spots scaled in, so like, maybe say like 500 shares at this point. And the brick is getting riper and riper and riper to fall back down, which would give us a spike up in the SVIX. That's what we're trading, the SVIX, where we can make all that money as the brick falls back down to earth, and we can cash out of all our positions. Or we can scale out too. We can scale out on the way down until we're back in our normal range again, or close to our normal range, where we can just get rid of everything, hit the reset button, and get ready to do it again. So that's the SVIX strategy. And really quick, let me just look at the position I have on this. So let's say that here's the SVIX. Let's say show all. So here we go. So again, let me go back at the chart for a second, and let me see where I got into this at. Okay, so here's the VIX. So once the VIX got up to around 17ish, I think, it got my attention, and then I bought those 100 shares. So it was up in this area here, around 16, 17, when I bought 100 shares. This is my first step in, it's my toe going into the water, as I want to scale in if it continues up. And worst case scenario, if it doesn't continue scaling up, it's going to fall back down to earth, and I will make some profit from 17 back down to its range. Even if it takes a while to do that, it will. It's my belief that it's going to come back down to earth, just like it's my belief the sun's going to come up tomorrow. But so here's where we got in, around 17. So let's just take a look at so I bought 100 shares. That was like 2 days ago, I think. And this shows that my position is up. I bought 100 shares of SVIX. This shows that my position is up $45. And let's take a look at that and see. So I must have gotten into it like right around here, 1750-ish probably. Because yesterday it moved down. The brick began to fall back down to earth right there. See it? Somebody tossed that gosh dang brick up into the air. I think that's a misprint right there, that long tail. Anyway, someone threw that brick up into the air here, and it got my attention about right here, 1750-ish. And I got in. I said, okay, the brick has been launched, and it could continue higher. So I don't necessarily want to put all of my eggs, all of my VIX bricks eggs into the basket at this point. I want to scale in, because if it continues higher, I can get into additional positions at a better and better entry point. Because again, remember, we're trading this SVIX. And so 17, let's say it was right here. I don't want to put all my money in there, because what if it continues down? I can get more shares at a better. If the VIX continues to go up, what we're trading, the SVIX here, is going to continue to go down, give me a better entry point, so I can scale in as we get lower and lower and lower and lower. And then if it doesn't get any lower, if that's the extent of it, if that's as high as the brick will go, and it looks like right now maybe that could be, because we're having a down day, we're falling back down to earth now, back to the normal range, which is right here. If we look at the SVIX, you can see this move here. So here's the down move. We got in. Let's say we got in around this area here, maybe 42-ish. So we can see exactly where we got in. Let's see, we got into this at 42.57, the charts. So 42.57, we got in right on this down move here 2 days ago. I got into this at 42.5, so right about there. So now the brick looks like it may be falling back to earth, which is causing the SVIX to do the exact opposite, go up. And so even that little bit of a move there, with that first 100 shares, I've made $47. And if it continues to come back down, the VIX continues to come back down, I have all this room here where I can make money. Once it gets into this area here, like say 15 to 12, that's where I would look at maybe taking it off. On the other hand, if it continues to move up, I'll just slowly keep scaling in, and most importantly of all, don't eat yellow snow. All right, so that's it for this one. If you found this video helpful or gave you some cool ideas, please be sure to leave a comment below, like, and subscribe. If you'd like to follow me on any of my other real money trades I'm doing, my experimental trades, my daily income trades, all that good stuff, make sure you're subscribed to my channel below. Also, be sure to join me on my website. I'll leave a link to my website in the description below. Head on over there, sign up for my free email newsletter. As soon as you get that, you'll get a welcome email from me. Just reply back to that welcome email. I'll see it, I'll get back to you, and we'll go from there. Hope you're having a great weekend. See you next time.
Important disclaimer. This presentation is for educational and entertainment purposes only. Trading has large potential rewards, but also large potential risks, blah, blah, blah. You must be aware of the risks and be willing to accept them in order to invest in the market, blah, blah, blah. Do not trade with money you cannot afford to lose. Past performance of any trading method is not necessarily indicative of future results, blah, blah, blah. Furthermore, no one that is involved with this presentation is a licensed broker, or a licensed professional, or a licensed anything, except maybe a licensed idiot who should have their ass kicked up and down the street and should not be listened to by anyone. So proceed with caution if you know what I'm saying. And don't say I didn't warn you. Okay, let's see. Where was I? Where the fuck was I? Okay, here we go. No advice of any kind is being given, blah, blah, blah. And, shit. You know what? I'm not gonna read through all this crap. Just pause the video and make sure that you read through all of it yourself, okay? Here's a short version. Just don't be a stupid fucking idiot.